Hello everyone, I want to welcome you back to my channel. If you are meeting for the first time, I'm CPA John Macharia. That is a certified public accountant of Kenya. And I'm also a BCom student at University of Nairobi. In our previous lessons, we discussed issues with bank reconciliation. And this time round, I want to discuss income statement. In the form of business, the motive is to make profit. Therefore, if you have to continue being in operation, your business must take care of your expenses. Regardless of which kind of business you do, whether it's a boda, whether it's a saloon, in the form of business, you must be able to account whether you're making profit or not. If you don't make use of your profit, chances are that you may end up closing down your business. If you start a business and that's where you are getting your school fees from, that's where you are taking your daily expenses from, you must be able to account how much are you making so that you can spend. There are two things that are involved in business. One is sales. What are you selling? It can be service, it can be product or good. The other thing is purchases. What are you buying? So when you come to income statement, I will be showing you how to know whether you're making profit or not. Thank you. Statement of income summarizes the trading activities, that is the sales and purchases of goods. Inventory is most commonly used because it refers to those goods that are purposely meant for sales of any business and tries to determine the gross profit for the relevant financial year. Statement of incomes, it also shows the net profit or the net loss that the business has made from all the activities during a financial year. The net profit or the net loss is determined by deducting all the expenses from the income of the same financial year. Now let's have a look at how to prepare the statement of income. It is important to note that this is the general format, but can be skewed towards the kind of business that you are having. Now, one thing that happens in any business is sales. So sales contribute to what we are calling revenues. So when you make sales, you record the first thing on your statement of income. Then you raise returns inwards. This refers to those sales that have been returned, either they are obsolete or any other defaults. Then there is cost of sales. Cost of sales here refers to all those items that are in that category that you have the opening inventory, or sometimes we call the opening stock. Then you have the purchases. Then on purchases, we have the carriage inwards. This refers to those expenses you incur to transport your goods to your store so that you can sell. Then you have the returns outwards. This refers to the stock that you purchase, but you found that maybe they are not of good quality. You return them back to the supplier. Then you have the closing inventory. So when you are calculating the cost of sales, returns outwards and closing inventory, you see they are in brackets. It means you subtract so that you arrive at the value where I have labeled A. A is not part of the format. A refers to the total of what has, or now A refers to the actual cost of sales. So when you subtract the cost of sales from your sales, you are going to arrive to a gross profit. Once you arrive at the gross profit, you need to add back other incomes related to your business like discount received, rent received, and interest received, so that you end up with the net gross profit. Once you're done with the gross profit, expenses are very critical in any business. The more the expenses you have, the less the profit you get. So in this case, some of the expenses may include carriage outwards. This refers to the cost of transporting goods from your warehouse or from your store to the customer. We have discount allowed. These are the discount you allow to your customers. Postage and stationery, salaries and wages, rent expenses, insurance, and bank charges. So where I've written B is not part of the format as well. This refers to the total expenses which are deducted from the net profit, not from the net